I forgot to press record, so I'm going to press record now. If we had done this test in class, you would have seen templates that I would have given you. So for instance, for like the balance sheet, I would have given you a template that would show the names of the accounts, and you would just have to figure out how to build the rest of the balance sheet. Similarly for the income statement. So I have no problem with people having references to formats, of balance sheet or income statement. You don't have to prove, I mean, if you want to prove to yourself that you can remember it, that's fine, but there's nothing that you need to prove to me, because again, I'm not sitting next to you. I can't see what you're doing. But I will say a massive caution. All right, listen now. The test is timed. Okay, you cannot go while you are in the test. You should not go to the textbook via the link to the textbook thing, because that decreases points on the test. All right. Also, do not try to do a second browser logging into Wiley to try and get to the textbook that way, because you will be kicked out of the test, which means whatever you did up to that point, that will be, your grade. And then you'll have to contact me to try and get you back into the test. So you already know, based on the test prep sheet, which questions I'm going to ask you, right? For exercises. You don't know for multiple choice, but the point is, the exercises. So please spend the time to study and figure out what supports you might need during the test. And if you need to print out a piece of paper, like say, oh, here's a good example of a balance sheet, let me just print this out and have it next to me. Or here's an example of an income statement, let me just print it out and have it next to me. Do that. But don't rely on the fact that you'll be able to go into the electronic textbook during the test, like through Wiley, because one, if you're doing it via the test, you're going to lose points. And two, if you try to do it outside in a second browser, you'll be kicked out of the test. You have someone's asking multiple attempts. Yes, you have 4 attempts per question, but remember you can choose by the second attempt, you can choose whether you want to see the account names or not, at which point you'll lose a little bit of the grade. I mean, we can go back into the prep sheet if you want to see how much, and then by the third attempt you also start losing points. So I guess what I'm trying to say is don't guess. Make sure that you studied and that you are aware of the, I guess, the requirements. Let me share my screen just to kind of, I guess, solidify in people's minds what's happening here. So for the test, in the second attempt, you do have access to the account names. And I believe, obviously I'm not a student, so I don't take the test myself, but I think from the way it's set up is that you can choose whether you want to see the names in the drop-down box or not. At that point, the maximum points you can get is 95% if you choose assistance for a drop-down box. Think about if we were writing the test in class, you wouldn't have any drop-down boxes. So there's a little bit of a penalty for that. After the 4th attempt, so then if you don't choose to see the account names, you can still get 100%. If you choose to see the account names, you're down to 95%. If you still make a mistake on the 3rd attempt, it's not a problem. You don't lose any points. Or the 4th attempt. But after the 4th attempt, your point potential drops again by 15%. So now you're down to 80% max point potential that you could have. Like I said, here's the exercises. Next to each exercise, I put what the similar exercises are for classwork and homework. I will put up the solutions for the chapter 14 homework, the full back of the chapter. I mean, I'll put it up today. I didn't put it up yet because obviously we are still doing that homework. So it doesn't make sense to put it up yet, because I want people to be able to do the work. And I mean, hopefully by now, most people have been doing, sorry, I just want to go to student view. Most people have been doing the homework. I just want to show you that as of now, your quiz and test are available, right, in the student view. This is the chapter 14 homework. It's due today at midnight. Everything else that's, very current stuff that you have to deal with is due on Sunday night. Any other questions here before we carry on with other stuff? You just see if anybody's looking for me in the chat. Okay, that was answered. Anything else, folks? All right. So if there's nothing else for now, I mean, think about it. If you have more questions, you're welcome to ask them as the class progresses. But we move on today. To talk a little bit about long-term liabilities, which is chapter 15. So if you maybe haven't kept track with where we are in the syllabus, we start chapter 15 now, and after 15 we have 17 and 18, and then we're done. 15 has a lot of, it has a variety of topics in it, but it's by no means as, in my opinion, as tough as 13 and 14. So it's a little bit of a breather, but I think the way it is 13 and 14, lots of small topics, lots of things to remember, lots of names of accounts and things and so on. And then 15, a little bit of a sigh of relief. 17, real talk here, but 17 is probably the hardest chapter. Statement of cash flow is probably one of the hardest topics in accounting in general. So, I'm just giving you the lay of the land. And then 18 is financial statement analysis, which is predominantly driven by calculating ratios, which is formula driven. So, the formulas would be provided to you. There's a sheet that you can print out to be able to know which items go into a formula. But, you do have to kind of be able to interpret the formulas to know what they mean. So, looking ahead now, as we think about where we're going, I think, or I'm hopeful that 15 won't give us too much trouble. But, you obviously, as with everything in accounting, it does require some practice. So I had said last week, Wednesday, that chapter 13 and 14 had to do with companies raising funds using equity. So, they're selling shares and they're kind of giving away parts of the company in return, receiving cash or services or other assets. So that's one way of raising money, right? Raising capital. Another way is to borrow. So when you're borrowing, you don't have to give anybody any piece of your company. You just say to them, yes, I need money. I'm going to take this money from you, and I'm going to make an agreement with you that after a certain period of time, I'll pay it all back. And in the meantime, there's a cost of borrowing from you, and that is interest that I will pay at various points, right, during that time. I think we're all fairly familiar with all kinds of borrowing, whether it be borrowing from another individual, or whether it be borrowing by using a credit card, or borrowing with a mortgage, right, to buy a property. All of those types of things are forms of borrowing. Specifically in this chapter, we'll be dealing with going back to this notion of notes payable. And a note payable is a short way of saying a promissory note, which is a promise to pay some money in the future. But the specific name of the note payable that we'll deal with first is bonds. A bond. So has anybody ever heard of the word bond, or know what a bond might be?
Is it like combining it's like it's combining income or something?
What do you mean by combining income? I don't know
Like
what that means.
like not income actually, but something that has to do like whatever you have to pay or whatever is left over.
Yeah, so I mean, it's definitely got to do
Um,
with paying a
I
bond.
would like to
Almost sounds
follow up
like
to
you
that.
are tied up, right? In a way. So it's got to do with having to pay something in the future. Sorry, did I hear something? I feel like I heard something in the
Yeah, I
background.
have something to elaborate on that actually. It's
Mm,
Debbie. So a bond would be something like a written agreement or maybe like a contract. So it's
mm-hmm.
basically between the holder and the issuer.
Yeah.
So it requires
Yes.
basically the issuer has to like pay something. They got to pay the holder for the par value or the face value. But plus
Yeah.
it's also the amount of interest.
Yeah. So you've got
Yeah.
someone, and you've precisely, there are two parties involved. There's definitely some type of borrowing involved. So in this case, remember, we're always looking from the perspective of the company. So the company is trying to borrow money from investors. It doesn't necessarily, in this case, we're not really talking about borrowing from a bank. Okay, a mortgage would be, and we'll get to that later, a mortgage would be more to do with borrowing, from one source being the bank. In this case, a corporation could go out and say, we need money, and we're considered fairly good, credit score and so on. So we are going to say that we will issue, right? Issue meaning basically sell a bond or multiple bonds to investors who want to borrow from us, and they will give us the money, and we will give them what essentially amounts to an IOU, and saying that in so many years' time, we're going to have to pay you back. And if you go and look at, we just go back to the instructor view. If we go to the chapter, I'm here in Wiley. I just want to show you, I believe they have why am I in chapter 14? Sorry. They have a type of, it might be a little bit oldish, but it's a kind of rendering to show what a bond might look like. Most of these things these days are online and electronic, but this does help. This rendering does help a little bit to understand it a bit better. So so the issuer, in this case, you can see it's a company, right? That is the issuer of the bond, meaning they sold these bonds, which essentially amount to a piece of paper, right? That is saying, I owe you $5,000 because you either gave me $5,000 today, or we'll see later that the bonds could be issued at a discount or premium. So you may have given me par value or face value, face meaning the front of this thing. So this is the face. So face value is 5,000. You gave me 5,000, or you gave me more or less, depending on the interest rates. And in a certain amount of time, I'm going to have to pay you back. In this case, you can see that the due date is shown here, right, as 2021. So the interest rate is also shown as 5.75%. So until from whatever date that they issued this bond, and I can't really see it from here, but I know it wouldn't have been this year because the book was maybe written a year or updated a year or so ago. So let's say for 2 years, they've been paying interest of 5.75% annually. They're going to owe the face or par value of $5,000 at the end, or not at the end, but on May 1st, 2021. The contractual interest rate is the proper terminology for this interest rate, 5.75%, and it is always quoted annually. The maturity date or due date is 2021, and that's the issuer. So this is a bond. So International Minerals and Chemical Corporation would have sold either this single bond or many of these bonds, depending on how much money they needed to raise, to various investors who obviously believed that they had the credit worthiness to be able to pay this back. And for however long from the time that they issued it to the time that they pay it back, they will have to incur the cost of borrowing, which is interest, and pay 5.75% on $5,000. Any questions on the mechanics of the setup here? Okay, so it sounds like by the silence, right, that people are kind of okay with this. So I just want to show you for a recent thing that happened. I'm sure we're all familiar with Macy's, or most of us are. Massive department store chain. Macy's has been going, not unlike many retailers, been going through a lot of trouble trying to I guess change their business model somewhat to suit the fact that people have stopped or many people have stopped going into stores, and they're buying online and they're very price conscious, etc. So as a result, Macy's is steadily struggled. Stock price has gone down, and also they've struggled financially. So their bonds, if they have any kind of debt, was downgraded to this is an actual rating. I know it sounds crazy, but downgraded to junk status. And the companies that do these ratings are companies like Standard and Poor's and Moody's and so on. I don't know if you've heard those names, but they're basically ratings agencies that look at companies and say to investors based on how they've studied these companies, right? So they could study this International Minerals and Chemical Corp and say, yes, this is a credit-worthy company. It's almost like when you look at your credit score, your FICO score, whatever, when you go to Experian or why am I blanking now? Well, let's Equifax and TransUnion, and you draw a credit report and someone can see what your credit score is. Companies have the same, right? So unfortunately, Macy's is down to BBB minus, which is basically junk. So what do you guys think? If your credit score is lower, like if a company's credit worthiness is not so good, will they have to pay more or less interest to someone who's borrowing from them? So if Macy's comes to me today and says, I want to borrow money from you, do you think I'm going to charge them a higher or a lower interest rate?
I would say higher.
Yeah, you're right, because there's a risk and reward situation, right? There's a direct relationship. The higher the risk, the more reward I want, and in this case, reward being interest. That's why even for us as individuals, if we have a not so great credit score, if we try to borrow from a bank or borrow from wherever, they actually charge us more interest because they feel that we are riskier. So they need a higher reward to lend any money to us. So why I'm talking about that is, earlier I kind of mentioned just on the side, and we'll talk about it more, that it's possible that companies could, issue this bond at face or par value, like we said, right? Or they could issue it for more, like higher than that or less. And part of why that is that companies have varying risk ratings, right, in the market, and as a result may have to kind of attract sometimes investors, or sometimes investors are scrambling. Everybody wants to give their money to the company. So the way that's dealt with is that basically the price of this bond, even though the company will always pay you back $5,000, they may sell it at a discount. So they may put this on sale because they'd say no one wants to give their money to International Minerals, but International Minerals really needs the money. They may say, okay, fine, no one wants to give us the money, so we're gonna sell these bonds at, let's say, 4,500 instead of 5,000, but you'll still get 5,000 at the end. So then people are like, oh, that's almost like giving us extra interest, so maybe we'll go for it. The other side of it is international minerals might be so popular that investors are just running to try and get into these bonds. And as a result, the price actually goes up because it's supply and demand, right? There's so much demand for it and less supply that the bonds get sold at a premium. So we will go through all of that in detail, but I'm mentioning this so that you don't think that every bond that is issued is just going to be issued at face or par value, just at the, this interest rate, and everything is going to be fine. Just remember a company like Macy's that may try to raise funds if things get really crazy, which they kind of are. They would have to really attract investors, and the way they'll do that is probably to try to slash the initial amount of money that investors give them, but still pay investors the par value back at the end. Any questions on that? So it's a little bit of a tricky concept. All right, think about it. Okay, so some of the kind of, just normal stuff, some of this we may have already covered. A bond is interest bearing. So a big part of this chapter is also knowing how to calculate interest. They're issued, meaning sold by companies in order to obtain large amounts of money. Of course, an advantage is that stockholders are left alone. You're not issuing more stocks. You're not affecting anybody's ownership in the company. And as you may or may not know, the interest expense, sorry, I don't know what's going on here. The interest expense is actually tax deductible for the company, just like your student loan interest. If you have student loans, I hope you know that the interest on those student loans is also tax deductible. So it lowers the company's tax burden. So stockholders, stay the same. Interest is tax deductible. But what are some of the drawbacks? I mean, it's all good and well to say, yes, that's great. The interest is deductible. The stockholders are left alone. But what's the catch with a bond? What do you have to do at the end? If you borrow money from someone, what do you have to do once the time period is up? You have to pay it
Back,
right? You got to pay it back. So there's still the issue that you have to pay interest. So interest isn't doing anything for us. I mean, it's basically a cost. If we're borrowing, interest is the extra that we're paying because that person was willing to give us their money that they could have used to do something else with. And then of course you got to pay it back. You got to make sure that you have the money available when the maturity date comes. Just like we spoke about with stock issuances, there are some considerations that a company needs to make when they decide to issue a bond. And remember, the word issue here is almost like saying sold. So if it's easier for you to think of the word sold, that's what this means. They have to think about how many bonds to issue, right? So remember, we were looking at international minerals. This one bond is for $5,000. Maybe international minerals only needs to raise $5,000 and they'll just issue one bond to one investor, and that's fine. But if international minerals needs to issue 10 bonds because they actually need $50,000, they may have to go look for 10 separate investors. If they need $5 million, they'll have to go and look for 1,000 investors and so on. Maybe some investors will buy more than one bond, so maybe it's not exactly 1,000, but the point is a company has to decide what the face value of each bond is going to be, what's the interest rate, and how many of these bonds do they actually need to sell in order to raise the amount of money that they are going to need. So how many bonds to issue, what's the face value, and what's the contractual interest rate, which is sometimes also referred to as the stated rate or the coupon rate. If you think about coupons that people sometimes clip from newspapers, back in the day, Doesn't look like this anymore, but back in the day, this bond would have had some coupons at the bottom of the bond that people would literally tear off and mail to the company, and then the company would mail them a check back. And that's why sometimes you'll see in the literature it's still referred to as a coupon rate, but of course we're far past the point of that type of thing where, you know, we're in the electronic age, so people are just getting their money via direct deposit. Yeah, so the face value, we already spoke about that. It's the amount that the investor gets at the end of the bond's life at maturity date. And the contractual interest rate is what the company will pay investors. It is usually an annual rate. Please be careful here, okay? It's an annual rate. And it may be paid semi-annually, so once every 6 months. But whenever you see a rate quoted in the questions and so on, it's going to refer to an annual rate. Sometimes people make mistakes here with the interest calculation because you see that the interest is being paid semi-annually and then assume that the rate that is quoted is also semi-annual. That's not the case. The rate is normally quoted at an annual as an annual rate, excuse me. Bonds are also traded. Sometimes they get bought and sold by investors. So of course they could be trading above or below, again, the par value as well. You know, as a total aside, I'll spend 30 seconds talking about this. You may or may not know, and I'm sure you've seen all the stimulus packages and things going. There is a huge issue in the markets with corporate debt because the interest rates have been so low since the global financial crisis, 08, 09. Companies have gone really overboard with borrowing. There's a lot of corporate debt that, you know, is still outstanding. And now with the COVID-19 pandemic, many companies are suffering and their cash flows are not what they expected. And so if you follow the business news, you will see that the Fed, you know, some of that money that the Fed was kind of printing, basically, I mean, let's be real, they're printing money, went for also partially for providing liquidity with corporate debt, because there's a big bubble there with companies having way too much corporate debt. I mean, households also have a lot of debt, but it's an unprecedented amount of corporate debt. So, you know, keep your eyes open for how that situation is going to play out over time. Unfortunately, it could be another, if things don't turn around quickly, it could be a potential for, you know, a different type of financial crisis again. So we're going to start now with the actual mechanics of how to account for bond issues. I just want to give you fair warning before we start that there are 3 types of issuances. There's the issue at face value, all right? And I'm sure people already have this material, but if for some reason you don't have it, remember it's under Zoom call materials on Blackboard is all the class notes and whatever you need, all right? So there's the issuance at face value. There's the issuance at a discount. Remember I said sometimes the company will almost put the bond on sale initially just to get people to invest. And then there's the issuance at a premium. This is the scenario where people are so excited to invest in these bonds that they actually are driving the price of the bond up. Okay, so we've got face value, which is the bond is being issued at the same price as what is written on the face, right? So if it's 5,000, that's what we're issuing it at. So we start here, and these examples are from the textbook, so you know you can see them there. On January the 1st, 2013, Candlestick Corporation, that's the name of the company. This is the date of the issuance. You want to be careful with dates in this chapter because you know it's going to determine interest calculations, it's going to determine repayment dates and so on. It issues, so it sold $100,000, right? So that's the amount of money that they are getting because they're issuing it at face value. So $100,000 face value, 5-year, that's what we would call the term or the time to maturity. That's how long the bond will be outstanding for, okay? 10% is going to be the contractual interest rate, but specifically annually. Remember, we said this is an annual quote. Bonds at 100. So this 100 looks very odd. What does this mean? Where does it fit into the picture? 100 here indicates for us that it is at face or par value because it is 100% of face value. So please watch out for this terminology. It's a mouthful, okay? So $100,000 face value, 5 years is the term or time to maturity. 10% is the annual contractual interest rates. Bond at 100% of face value. The bonds pay interest. There's, the catch. The interest is semi-annual, which means it's every 6 months. So this 10% has to basically be divided by 2 when you are calculating interest, right? Because you would calculate the interest that would be paid on January the 1st and July the 1st. Do you think that since we're issuing the bond on January the 1st, 2013, do you think that there would already be an interest payment made on day 1? What do you guys think?
I would say no.
You are correct. And why is the answer no?
Because at the very first, how would you pay interest when you didn't even start the contract or anything?
Yeah, that's the answer. So interest is a function of time passing, just like if you had to take or if you buy something on your credit card and you don't pay off the full balance, you're not going to get charged interest today when you buy the thing on your credit card because there's no way for the bank to predict whether you're going to pay on time or not. If you don't pay off the entire balance after a particular amount of time, then you will be charged interest, right? Same with your student loans. The student loan interest will only start accruing once you have actually been taking the money and using it. So interest will always be a function of time. So you're never going to end up paying interest on day 1 because no time has passed. So don't worry about calculating interest when you are issuing bonds, right? That's why I asked that question, because you have to remember there's no interest calculation on the date of issuance, but there will be interest calculations at a later date. So for the journal entry for the issuance of the bonds at face value, you're thinking about this from the perspective of the company. The company is selling the bonds, they are receiving money, but they will also have a liability because they will have to repay these funds at the end of 5 years. So since everything is being sold at face value, you can use this $100,000. You debit cash because you are receiving money, right, from the investors. Just hold on. Okay, wait, let me just save this as a Google Doc so I don't have to keep getting these error messages. All right. So $100,000 debit to cash because the company is receiving cash. Then the liability is called bonds payable, right? The amount is to be paid. So it's payable, 100,000 credits to recognize the liability. Any questions there? All right. So that's the journal entry for issuance, right? For when it's sold, that would be on January the 1st, 2013. Again, no interest calculation at that point. So now here's a theoretical question. Bonds payable will be a blank liability in the balance sheet because the maturity date is more than 1 year away. What type of liability will that be if you only have to pay it in more than 1 year?
Long term.
Yes, thank you. Who is that speaking?
OJ.
Thank you. long-term liability. All right. Once the bond gets to, once we get to year 4 and there's only 1 year left, then it becomes a current liability. But for the time that the maturity is more than 1 year away, you've got a long-term liability in the balance sheet. Okay, so that's the issuance of the bond. That is how the bond would be seen or treated in the balance sheet. Bond interest. So remember I said a big part of this chapter is also being able to calculate interest. There is a formulaic approach to interest, right? I mean, I'm sure you guys may remember this to some extent from your accounting 1 days or maybe some of your other classes. Interest is based on the amount of money that was loaned or borrowed, the annual interest rate that is quoted, and then how much time has passed, right? We were just talking about that when we said we don't charge interest on day 1 because no time has passed. I find that normally students don't have a problem with the face value. It's obvious. The interest rate is also obvious. It's this piece that sometimes gives us some problems because we have to actually count sometimes months from a particular point to see how the interest works. So remember we said that this interest gets paid semi-annually on January the 1st and July the 1st. So the first date that we're going to hit, right, since we issued the bonds on January the 1st, but we obviously don't calculate interest or pay it at that point, the first date that we will hit is July the 1st. So between January the 1st and July the 1st is 6 months, right? It's obvious because it says semi-annual. It's also obvious if you just count out the months. This is how the journal entry looks in terms of the names of the accounts. Interest is an expense because it's a cost of borrowing. Expenses increase on the debit side, so you debit interest expense. At this point in July, the company actually has to pay the interest in cash, so cash and asset is going down, the assets go down on the credit side. Does anybody want to, or everybody can try and do the calculation and see if you can figure out what the interest amount should be for July. Just take a minute and see if you can figure it out.
For the whole 6 months, the half year?
Yeah, for the half year.
Is it 5,000?
That's correct. So let's go through it. You're going to take 100,000. You're going to do 10%. And then you can divide by 2, or you can say it's 6 months out of 12 months is going to give you $5,000. So again, the classic error that we sometimes make here is to forget that it's only for 6 months. So we try to put 10,000. Remember, you only want to charge as much interest that is applicable for the amount of time that has passed. Any questions on the interest calculation? So far, so good. Okay, so interest, debit, interest expense, debit, cash, credit. Now, if we assume that this company has a year end that ends on December the 31st, right? What ends up happening is we're in a little bit of a quandary. We have a bit of a problem because the next interest payment date is only January the 1st. Okay, so the company's year runs from January the 1st to December the 31st. By December the 31st, 2013, you've actually incurred or accrued 6 months worth of interest that has not yet been paid. It will be paid on January the 1st in the following year, but based on, and this is one of the most hated chapters in Accounting 1, Chapter 3, which is the adjusting journal entries because of accrual accounting, meaning that the transactions have to be recorded as they happen, right? So expenses are recorded when they happen, when they are incurred. You are required to make an adjusting entry to record the interest that is owed at the end of the year. And so you debit interest expense to show that we did incur a cost of borrowing from July the 1st to December the 31st. And that cost of borrowing is the 6 months worth of interest, right? But we did not yet pay it in cash because January the 1st, the next day, has not yet arrived. Questions there?
So basically, it just accumulates.
Yeah. I mean, it's an accumulation. It's an accrual. It's, you know, the technical term. It's an accrual. It's an accrued expense. And what happens? So this is 12/31/13, right? Sorry. And what happens on 1/1/14, just to close the loop here, is that you will then say debit interest payable, right, to get rid of the liability, and you will credit cash. This is when you pay the people. But you're paying them the interest related to 2013. It's just that it's due to be paid in January. So you record the expense in the year that it belongs to, but the cash payment happens in the next year.
That's when it gets paid. But what happens if it doesn't get paid? So basically, it's like a 5-year, right? So the second year.
Oh yeah, so be
add up.
careful. So thank you for asking that. Remember, it's a 5-year term until you have to pay back the 100,000, but the interest gets paid every 6 months.
Also, what? So if it says it could be every 6 months or every year, they get paid out.
Yeah. So yes,
Okay.
so be careful. So the people are not, in general, I mean, there are some financial instruments where people wait until the end to get the interest, whatever. Don't worry about that. We're not going to deal with that. But in this case, the 5 years is not referring to, you know, you wait 5 years for your interest. The 5 years is referring to when you pay back the face value. The semi-annual or the annual, depending on, you know, how your question stands, that stuff is happening during the 5 years. Every 6 months, people are getting paid $5,000. Make sense? Hello? Yes?
Yes.
Okay. Because, you know, again, from an investor's perspective, you know, just to completely close this loop, there's such a concept, and maybe you guys have heard of this, of the time value of money. Like, if I'm going to give you my money for you to be able to use however you want to use it, I have an opportunity cost. Like, I'm losing out. I'm not able to use my money. So I need to be compensated for that. And if I'm going to have to wait till the end of the 5 years, you're going to have to pay me way more than 10%, right? Because that's a very long wait, and I could have been doing all kinds of stuff with that money. So, you know, from a finance perspective, it makes sense that we are paying the interest periodically, even though we're paying back the face value at the end. All right, so here's some more theory. Interest payable will be a blank liability in the balance sheet because the maturity date is less than 1 year away.
Current liability.
Yes, whoever said that, I heard you. It is a current liability because we are less than 1 year away. So why do we care, right? This is back to like the classified balance sheet, you know, all those good things in accounting one, how you classify assets and liabilities based on their time, you know, for liabilities, time to maturity, for assets, their use, the time that you'll be using them, is because you're communicating. Remember, one of the main purposes of financial statements is communication. You're communicating to the users of the financial statements when these liabilities are coming due, so that people can actually compare. For instance, a current liability of $5,000, I can go look at your cash account and see, oh, thank goodness, you have more than $5,000 available, so you probably will be able to meet your obligation. If I knew that you had a current liability of $5,000 and you tell me in the financials you have to pay it by January the 1st, and I see that you only had $2,000 in cash, that will make me be concerned that you may not be able to meet your obligations. So we split the liabilities between the things that are going to have to be paid off, way in the future, and we understand that you still have time, so we don't have to panic too much, and the things that have to be settled within 1 year. In this case, not even within 1 year, it's basically within 1 day that they have to settle the 5,000. All right, so any questions there? All right. So let us look at, hopefully people have these things again. Look at exercise 1 on what's called here the additional exercises for chapter 15. So we'll look at exercise 1. I'm going to throw, most of this back to you guys to do, because it's basically almost the same thing as what we were just demonstrating a minute ago. But I will read it with you to remind you of what all these numbers and percentages and things mean. So Bonanza Corporation issued, so we know that means that they sold $2 million, that's the face value, right, of 8%, the annual contractual interest rate, 5-year bonds, that's the term or time to maturity, also on January the 1st, 2013, that's the issue date. Bond interest is paid, there we have it again, semi-annually on July the 1st and January the 1st. The same terms, right, as the previous question. Prepare the journal entry for the bond issue at par. So par and face value mean the same. There's 3 ways of saying it, just to keep things as confusing as possible. They could say par, which means face value, which also means 100, okay, 100%. We go back to International Minerals, right, 100% or face value is this number that's on the front of the bond. So, so they want you to do the entry for the issuance at par. Remember, we just did that over here. That was the first journal entry that we did. That's the journal entry for the issuance of a bond at face value, right, which is par. Then they want to do the journal entry for interest on July the 1st. So where did that come up? Here's the journal entry for interest on July the 1st. Then you got to do, so yeah, remember we spoke about the accrual of interest on December 31st. We just did that. There's the journal entry for the accrual of interest, and finally the journal entry for payment of the accrued interest on January the 1st. All right, so what I'm going to do now is give you, let's say, 7 or 8 minutes, about 2 minutes per part. I know it sounds short, but you guys basically have the answers in front of you, to work through this question, and then I'll go through the solution with you. All right, so let's say about 8 minutes. So by 11:32, we'll take answers. Don't shout out anything. If you do have questions, but don't ask me a question like, is this the right answer? Just give everybody a chance to go through it, and then I'll take volunteers at 11:32 to walk us through the solution. Okay, so let's go with the solution. For the prepare the journal entry for the bond issuance at par, which is 100. What are we debiting? What are we crediting?
Cash and bonds payable.
So, sorry, let me just go back to the proper answer. So you're debiting cash 2 million, crediting bonds payable 2 million. You don't have to do the narration here. I just have it here. Bond issued at par. That's the answer for the part A. And then journal entry for the payment of interest. Interest is going to be the 2 million times the 8%, but you can't stop there because this is only for 6 months, right? So what's the journal entry for payment of interest?
As it comes 160,000, you divide that by 2 and it becomes 80,000.
80, yeah, so we got to be careful with the number, right? 80,000, debit, interest, expense, credit, cash. I hope everybody's noticed while they were doing the question and also seeing now that these answers are basically the same as the example I just went through, you know, with you. So, you know, hopefully is not as painful. Prepare the adjusting entry for the accrual of interest, right? So you've got the expense again, but instead of putting cash, you are putting interest payable. And then the last piece for January the 1st, Jimmy, what did you have? Debit?
You mean 80,000?
Expense.
80,000, okay, yeah. Interest payable and cash. All right. Questions, anybody on that? It's as difficult and as simple as that. All right. For bonds that are issued at face value, it's just a matter of making sure that you're reading the question properly, which was why I was reading it so slowly.
Can you please repeat the step B?
Part B, absolutely.
Yes.
So prepare the journal entry for the payment of interest. What part of it? Is it the calculation or the account name? So you okay with calculation?
Yes.
So remember from the theory, we said that interest is going to be the face value times the annual interest rate times some period of time, right? We just don't know what that necessarily is. In this question, it's 6 months that we have to calculate interest for because we're calculating it from January the 1st to July the 1st. So you're going to say 2 million times 8%, that gets you to 160,000, but you only want half of that. So you divide by 2 and that's how you get to 80,000.
Okay, thank you.
All right, no problem. Anything else? If it was annual interest, obviously you would just stick to 160,000 and you would only have interest being paid once a year, most likely at the end of the year. Because if it's a one-shot thing, annual interest, then you have to wait for a year to pass for a year's worth of interest to be charged. Okay, good. So just quickly, I mean, I'm aware of time, but I think we can do a little bit on the bonds issued at a discount before we have to sadly say goodbye to each other at 11:50. So remember I said bonds can be issued at face value, which is just the amount that is on the bond, or they could be sold for cheaper than that because a company is trying to attract investors and saying, okay, you know, people don't seem to want to buy these bonds, so I'm going to sell them cheaper than face value, but I'll still pay you face value at the end. So in a way, you're actually making some extra interest. So why does that happen? Because, you know, investors are smart. They don't just look at one investment opportunity and say, oh, I could invest in these bonds. They say, well, I could invest in these bonds or I could invest in these other bonds. And which one has the highest interest rate, right, that I'm going to earn is probably the one that I will go with. So if the contractual interest rate on a bond, by contractual interest rate, we mean this rate over here that is displayed, right? So if the contractual interest rate on the bond is less than, right? So it's lower than the interest that is being offered in the market. then investors don't want to pay the full price of this bond, because if you're telling me you're going to give me 5.75%, but I can go somewhere else in the market and get 6% or 7%, why should I even invest with you? That's what investors are saying. And then the company is like, we can only afford 5.75% right now. We can't afford to pay you a higher interest rate every 6 months. But what we can do is decrease the amount of money you have to give us today to basically put the bond on sale. And then at the end of the term, at maturity date, we will give you the full face value back. So that's a discount. It's like if you go, well, I mean, we're not going into stores right now, but if you go online and you see that something is on sale, the price of that thing is obviously less, right? The sale price is less than the regular price because they're trying to attract people to buy it. It's the same idea over here. So when does a bond get issued at a discount? When the rate that the company is offering, the contractual interest rate, is less than what the market is demanding. Basically. Right now, are interest rates very high or very low? Does anybody know?
Hi.
Hi.
No, the other way. Remember, the Fed cut the interest rate a lot. So interest rates from like the Fed funds rate is hovering close to zero. I mean, think about if you have any savings at the bank. Are you earning a lot of interest on that right now?
No.
No. So interest rates are pretty low right now. So, I mean, investing in debt is basically not, as attractive as it would normally be. But, if a company at this stage, right, if a company had to issue bonds, they would probably issue it at a fairly low interest rate because they don't have to compete, that much with the general market interest rate. But in, future days, I guess maybe when interest rates pick up again, there might be a situation, where a lot of bonds are being issued at a discount because the market is demanding higher rates than what the company can offer. So looking at this bonds issued at a discount example, I don't know why I left the answer here, so apologies, but I'll walk you through it. On January the 1st, 2013, so the same date, right, Candlestick Corporation issues $100,000. That's the face value of what they sold. 5-year, there's the term, 10%, there's the annual interest rate bonds for in the previous example, it was sold for 100 or par. Right now, it is being sold for less than, about $7,000 less than face value. So immediately when you see this, or if they had given it to you as a percentage, 92.639% of face value, or they could also just write it as I'll just write it over here. They could say they sold it at 92.639, then you need to know that that means that it's 92.639% of face value. So you're multiplying the 100,000 by that. So immediately you see that the amount is less than face value, which tells you that this bond was issued at a discount, which leads us to a new account name that we haven't seen before called discount on bonds payable, right? Not a very creative name, but at least we understand what's going on, what this account is for. So what this then means is that the company is actually only receiving $92,639 in cash. They're actually taking a hit, right, at the issue date and saying, we'll take less money from you to attract you to invest in us, right, to give us your money. And however, we will still pay you back. How much? How much will they give back at the end? Still?
100,000.
Yeah, still face value. So please note that even if a bond is issued at a discount, which is in this case, and next time when we come together, we'll look at the premium option. But even if a bond is issued at a discount, at the end of the 5 years, the end of the term, the maturity date, you will still have to pay back the full amount. So what this discount really becomes for investors, since they get this extra 7,361 at the end, it's almost like an additional amount of interest, right, that they are being paid. In addition to the 10%, they're also getting 7,300. But that interest, you know, quote unquote, is only going to be paid to them, you know, at the end. So in the meantime, when you calculate interest for the regular coupon or contractual interest rate, you'll still use the 10% on 100,000. I repeat, even though a bond is issued at a discount, when you calculate interest, because this is a contract and a contractual interest rate, you will still use 10% and 100,000. And in this case, interest is semi-annual. So interestingly enough, the interest calculations will look the same for a bond, you know, the payment, the amount that needs to be paid will look the same if the bond is issued at a discount compared to if it was at face value. So how does the journal entry for the issuance run? If the bonds are at a discount, you debit cash with the actual amount received. Cash is a fact, so you can't change that. The bond payable will always go in at face value. It doesn't matter if that the bond was issued at a discount. And then the difference goes to discount on bonds payable, which is, here we have this word again, contra, right? We had it with treasury stock as well. It's a contra liability account. It's a liability account, but it increases on the debit side. So it's a liability account that increases on the debit side. And it's deducted from bonds payable. Okay. So how does that look? Let me see if I can, I hope I'm not going to be thrown out of the textbook because I logged in some time back. Good, I'm still in. Yeah. So if you'll see this, remember I told you this, these candlestick examples are it's from the textbook, okay? So if you look at a partial balance sheet, there's the long-term liabilities. Remember we said that a bond is a long-term liability because it's due more than 1 year from today. There's the bond payable at face value, right? The 100,000. This is these are not the same numbers, but the point is you can see over here, this is how we treat discount on bonds payable. We subtract discount on bonds payable from the bond face value to get to what we call the, carrying or book value of the bond. All right. So when we say contra liability, this is what we mean, that the discount on bonds payable will eventually be deducted from the bond payable balance in the balance sheet. You should have some memory, maybe as I'm saying this, of something like treasury stock. It's the same idea, right? It's being subtracted from the other balances in the balance sheet. Questions on that and on the treatment here of discount on bonds payable? All right. So it's a contra liability, and then bonds payable minus discount on bonds payable, like I just said, is the carrying value or the book value of the bond. It's an important concept to remember because later on when we do the redemption of the bonds, you will have to remember what the carrying value is. And in this case, it's for a discount bond, it's a subtraction. When it's a premium, we'll see that you add. And the interest that is paid to investors, the cash paid, even though we're at a discount, will still be the same 5,000 because they've contracted to pay the 5,000 even though they got less money at the start. All right. So I guess next time, because we won't be able to do this now, but next time what we will do is this example where, you know, you have a bond, it's issued first at face value. Here you can see how they quote, right? How do we quote a discount? So this is 95%, right, of a face value. And eventually we'll also learn how to deal with a premium. Obviously, you can see a premium is going above 100%. And if you're curious, I mean, you can just keep scrolling down. You can see that with a premium, we get more cash than the amount of the face value. All right. Any last questions on this example with a discount on the bonds? Let me just check the chat window. Nope. All right. So I guess I'll leave you with saying again that I do have office hours as usual today. The office hour code is in the chat window. Please bear with me with this meeting. It's supposed to end at 1, so I'll dial into the office hours as soon as the meeting is over. If it does run over, it's not my meeting, so I won't be able to end it. And then, you know, for those who may have joined later, just a reminder that all the information that you need regarding the test and the quiz are up here on the tab, and you have until this coming to finish, but it is timed. You've got 2 hours to answer those 10 multiple choice questions. On the quiz, I deliberately extended the time because of internet connectivity and so on, and then 4 hours for the test. There's all your similar examples for class examples and homework examples. Anything else that I should be talking about or thinking about before we say goodbye? Anybody else have a question that they need me to answer?
I have one question. What happens if they just give you the share amount, but they didn't give you the face amount?
If they give you the, sorry, I don't understand. If they give you the share amount?
Like they issued a certain amount, but they didn't give you the face value.
It's not possible because you wouldn't be able to do the journal entry. There has to be a way for you to know what to credit to bonds payable. So, I mean, it's possible that some of these questions have the face value right at the beginning of the question, and sometimes people miss that. But there's no way, like someone can't just tell you bonds were issued at 95 without telling you what the face value is, because you won't be able to do the journal entries. Do you follow?
I think so. My head is, I think it's got burnt.
Yeah, I mean, just look at this just quickly, because I got a boogie, but look at this, right? Prepare the journal entries to record the issuance of the bonds if they were issued at 195,102. There's no way you could do the question without this 100,000. You can't, right? Because 100% of what? 95% of what, right? 102% of what? They gotta give you somehow, somewhere. You have to be able to know what the face value is. Right?
The reason why I asked is because it's the homework.
Yeah, I know. I suspect. So just send me a screenshot via email of what you're looking at. I suspect either something is buried somewhere or there's a preamble to the question that where you may be missing the face value. All right?
Yeah, I keep on trying to. I calculated it twice. I keep on getting it wrong, so I might be.
So just don't what's name yourself, like antagonize yourself. Just send me a screenshot of what you're looking at, and I'll help you. It will probably take 2 minutes. All right? And that goes for everybody. If you guys are stuck, not so much on the test, okay? Don't send me questions for the test. I can't, unless it's something that seems like totally wrong. I wouldn't be able to help you on the test like that. It's supposed to be up to you. But if you're busy with something and you're stuck, please just email me. You don't have to come to office hours if you can't, but don't suffer in silence and don't waste your time, because sometimes it's something really obvious, or sometimes there's something wrong with Wiley, and that's why your answer keeps coming up as incorrect. All right?
Thank you, Professor. Enjoy your meeting. Yeah. Ask for a raise.
No, that's not going to happen. I mean, there's a hiring freeze. You know, you never know. Some of us, I mean, I'm tenured, so thank God for that. I probably will keep my job, but there are, you know, a lot of problems on the horizon. So I will just hear what they have to say. Okay.
And also one more thing on the chapter 14 homework, we didn't get the credit for the essay. part.
Yeah, because I only go in and do the grading when the deadline is finished, in case people want to go in and amend their answers. So I don't grade the essay question before the time, because you still have until midnight tonight. So tomorrow morning I'll go in and just grade across the board. Okay?
Thank you so much.
Okay, dokes. Bye, guys. I'll see you soon.
See you. Take care.
Hi, Professor. Take care.
Bye.
Bye. Bye.
Dear
Professor Francis, have a question.
Yeah, quickly, because I got like a short amount
Okay,
of
sure. Remember the class that we had last time, right? So it was under chapter 14 notes, right? Under solutions.
the test you had under chapter 14 notes.
No, not the test. Remember the class notes for last time,
Oh,
right?
the class. Oh, yeah. Okay.
It's
Yeah.
under chapter 14 notes.
Are you asking me where I put the solutions?
Yeah. No, like what was the heading of it was under solutions. It was chapter 14 solutions.
Yeah, under the solutions tab.
Okay, and you're about to put the one for today's class, correct?
Oh, you mean my rough workings. Okay, I got you. Yeah, I have to see if I put the rough workings from last week Wednesday anyway, actually. Thank you for mentioning that. I may not have put, because I put the solutions up already under solutions S20. So I may not have, because it's kind of repetitive, unless there was something specific that you wanted from the rough workings, because even today's solutions, I'll just put up the actual solution document, because it's the same thing.
Okay, but the last week was chapter 14 solution.
Yeah.
Okay, that's all I wanted to know, because I want to practice off of them and study for these quiz and tests, you know?
Yeah, so just 1 second, I'll show you. You will go,
Yeah, it was under solutions S20 and then chapter 14
it's this classwork solutions.
That's all I
it's
wanted
all
to
there.
know.
Yeah, it's all there. You're good. Okay?
Yeah, I just wanted to know if it was chapter 14 solutions. That was it.
Yeah, that's right. Okay? Okay.
All right.
Bye, guys.
Bye.